In this video, we will discuss dividends and share repurchase agreements. My name is Kirby Arcundiff. I have a Ph.D. from the University of Illinois at Urbana-Champaign. I'm a chartered financial analyst and a certified financial planner. I'm currently chair of Accounting and Financial Management for the Graduate School of the University of Maryland University College. There are three primary theories about how a company should choose its dividend to maximize its stock price. These three are called the dividend irrelevance theory, which is what it sounds like. It doesn't matter how they set the dividend. The bird in the hand theory, where investors are believed to trust companies that pay higher dividends since they actually see cash. And the tax preference theory, where investors don't want dividends because they're taxed at a higher rate than other forms of income, such as capital gains. If we look at the stock price as a function of payout for each of these theories, again for the dividend irrelevance theory, rather like the Modigliani and Miller irrelevance theory, it doesn't matter what a company pays out in dividends, whether 0% or 100% of its net income, the stock price will not vary. For the bird in the hand theory, again, companies are not trusted that much by their investors. This would certainly be true if you don't trust the company's accounting, but if you get a check every month or every 6 months in the mail or deposit in your bank account, then you're far more likely to trust the company, and therefore, the higher the dividend payout ratio, the higher you're going to value the stock. If you do trust a company's income and balance statement, but you don't want to pay a lot of taxes, then you will try to avoid getting dividends, instead get what is traditionally taxed at a lower rate, capital gains, and therefore you will want to invest in companies that are high growth companies and don't pay out a high dividend. So under the tax irrelevance theory, it doesn't matter. This is just like the Modigliani-Miller capital structure theory. It would be true if there were no taxes, no capital gains taxes, no dividend taxes. Therefore, if you wanted to own the stock, you received a dividend or a capital gain, you'd just buy more stock. If the stock price went up and you needed cash, you'd just sell the stock. It wouldn't matter if there were no taxes on your stock or dividend or capital gains income, and no brokerage fees to buy back and forth, and also no chance of bankruptcy. Therefore, the bird in the hand theory wouldn't really matter because you'd trust the company. So under these conditions, it just doesn't matter what happens. What generally complicates everything, of course, is taxes beyond things like brokerage charges, which are much smaller now than there used to be, and then there's always the chance of that company going bankrupt. So again, on the bird in the hand theory, stockholders are far more likely to trust a company and buy its stock if they regularly receive a cash payment. The U.S. has had plenty of corruption issues where companies have published questionable income and balance statements like Enron and later on gone bankrupt. If you received a check from that company, you'd be a lot more likely to trust it. Recently, a person I know in Dubai invested in something called the STAR account, which promised very high rates of return, but when she attempted to get money out of the account, there was always a reason it wasn't available. So while on paper, her dollar value kept going up more and more and more, in reality, she was being ripped off, similar to a Bernie Madoff scandal, and lost around $10,000 by investing in a scam. This is an environment where you can't trust the company, and the bird in the hand theory is appropriate. The tax preference theory seems to have been the most correct theory in the United States, at least since World War II. Around World War II, the S&P 500 had what today would be considered very high dividend payments of 6%, well above what you receive in a bank account. Now they're below 2%. This is for two reasons. One, people are in fact avoiding dividend taxes, and two, of course, the Federal Reserve has kept lowering interest rates to the point that bank accounts basically don't pay any interest. So if we look at this graphically, we can see here The rate of return is a function of year, starting in 27, going to 2007 for the S&P 500. In 31, we had dividends up to 10%, 8% in 43, 6% in the 50s, and again, now they're down around 2 or below. The Treasury bill went to pay close to nothing during the Great Depression, up to above 14, 15% when Paul Volcker was fighting inflation in the early 80s. He just died this past week. And then back down to today of being down again 2% are very, very low. So both due to the fact that overall rates of return has gone down as the Federal Reserve has lowered interest rates, and also due to the fact that dividends most of this time period have been taxed at a much higher rate than capital gains. The S&P 500 has continually lowered dividend payments, which is consistent with the tax preference theory. This is a graph of dividend tax rates versus capital gains tax rates from around 1960 to close to today. You can see during most of this time period, the dividend tax rate was much, much higher than the capital gains tax rate for top income individuals, which would inspire these people who were the main stockholders to want to avoid dividends and instead have capital gains. This would be consistent with the tax preference theory and is one of the reasons between World War II and today that dividends on the S&P 500 have continuously decreased, again from around 6 to below 2%. This has gradually changed over this time period. When John F. Kennedy was elected in 1960, he believed that income tax rates in general were way too high. He believed in now what is called supply-side economics, that if you cut taxes on the top individuals in the country, they would work harder and invest more, and that would grow the economy. And he pushed for these tax cuts. They took place after he was assassinated, lowering the top income tax rate from 90 to around 70% on dividends and income. And consistent with the supply-side economics idea, the economy grew at that point, and in fact the government was able to raise more revenue through taxation at a lower tax rate than at a higher tax rate. These ideas were pushed again by Ronald Reagan when he was elected, and he pushed the income rate, which included the capital gains tax rate, down from 70% to 28%. After Reagan left office, George Bush Sr. and then Bill Clinton both increased taxes up to around 39.6%, but dividend taxes were later lowered even more by George Bush Jr., even though regular income taxes did not go down. So today, there really isn't any major taxation difference between capital gains and dividends. Therefore, well, it is no longer likely that the tax preference theory would be dominant. You have seen a few companies after that, like Microsoft, start to introduce more dividend payouts. Another important issue when a company considers how to alter or set its dividend policy is the clientele effect. People invest in stocks or bonds for different reasons. Typically, young people are looking for retirement 30, 40 years down the road, and therefore they do not want to pay taxes now. They do not want a dividend now. They do not want an interest payment on a bond, and they're going to invest largely in stocks and non-dividend paying stocks. But as people approach retirement, they give up their employment or are no longer able to work due to physical disabilities, and therefore they need something to live off of. Might maybe get something from Social Security, but a lot of people also get income from either bonds or dividends from their stocks. Therefore, as they grow older, they would prefer high dividend paying stocks. Commonly in the past, this has been things like public utilities. Of course, today, bonds don't pay hardly any interest, and it's getting much and much more difficult for somebody to retire on a portfolio based on its income. Instead, they would gradually have to sell stocks and get some sort of a capital gain. The clientele effect is strong enough that once a company sets its dividend payout ratio, they're very reluctant to change it. If you have a high dividend paying stock and you have elderly people who are living off the income from that, if you cut that dividend, that will very much upset the clientele. They might not be able to pay for their groceries anymore, and they will therefore sell their stock. As a result of this, even if a company is doing badly and its earnings drop drastically, the company might continue a stable dividend, even if they can't afford to pay it, borrowing for some time period to make sure their clientele stays happy, and hopefully the company's earnings will pop back up again to support that dividend. One of the most famous negative demonstrations of the clientele effect is the IBM dividend tax cut of the early 1990s. In the early 1990s, IBM was having significant financial problems, and for the first time in history, it significantly cut its dividend in 1993 and also fired its CEO, John Akers. The dividends were cut by over 50%, and during the next year, IBM's stock price dropped by over 60%. This was an example where IBM Big Blue was considered a very stable company, and a lot of retirees invested in it for the high dividend to pay for their groceries and other retirement expenses. When IBM was forced to cut its dividend, the investors were obviously not happy. They sold it, abandoned the company, and went to other more stable stocks because they needed the income as retirees. And this was a major signaling effect of financial problems for IBM. When companies decide how to set their dividend, they typically first look at something called the residual dividend model, although in the long run, they don't actually use it to directly set dividends. The idea behind the residual dividend model is the dividends paid out are whatever a company does not need for an expansion. So in a given year, the company's net income is NI. They can either use that as retained earnings or pay it out in dividends, of course, do stock buybacks. The retained earnings they would need for expansion would be WS, the fraction of the company's capital budget financed with equity times the capital budget. So that term, WS times the capital budget, is the retained earnings. That's invest to expand the company. Whatever is left over after that and net income can be given back to the stockholders in one way or another, potentially in dividends. The problem with this is it's not stable. A company's net income will go up and down every year. Therefore, there is no clientele that would be happy with the residual dividend model. So a company might look at this. It might look at the last 5 years of average earnings, calculate what the dividends would be paid out based on the residual dividend model, maybe divide that by 2 or 3 if the earnings are reasonably stable, and therefore they could then have a stable dividend payout. And of course, over time, as the company becomes more stable, they will not need to invest nearly as much in new equity, and they can increase their dividend payout ratio. An example of a company with a very high dividend payout, at least compared to the S&P 500, is ExxonMobil Corporation, with a dividend payout of 5%, whereas the S&P is around 2%. ExxonMobil is a relatively old, stable company with reasonably stable earnings, and while they have to invest some in things like finding new oil, and their income may go up and down with oil prices, their income is certainly stable compared to a new, growing tech company, and as a result, they can pay out a relatively high dividend and support a retired clientele. Well, it is far more stable now than 10 or 20 years ago. Amazon.com is still a relatively quickly growing tech company. It is investing most of its income in expansion and therefore pays out no dividend. It also has a very high price to earnings ratio of 77, whereas the price to earnings ratio on ExxonMobil was down around 20, about average with the S&P. Amazon has a price to earnings ratio much, much higher than the average stock in the S&P 500. If a company does not pay out dividends, it might be more likely to engage in a stock repurchase agreement. Stock repurchase agreements have many advantages over dividend payouts. One of the biggest one is you don't need a stable income to engage in them. If a company has a lot of extra money this year, it doesn't need for investment. It can just buy back stock and get that stock price up, basically get a rate of return to its investors without having to worry about any effects of a clientele effect. There's no stable dividend necessary. The money goes out to the investors. It also historically has had a generally favorable tax treatment. A stock repurchase agreement makes the stock price go up, creating a capital gain, whereas dividends were considered historically regular income and taxed at a much higher rate. A disadvantage of a stock repurchase agreement could be in some situations, particularly with smaller family-owned companies, the IRS may be considered a legal tax avoidance mechanism to avoid paying a dividend and therefore examine the company in more details. In recent years, many companies have increased their stock repurchase agreements to change the amount of leverage in the company since they can borrow money at such a low rate. You can see that issue here. The debt issuance of companies has gone up significantly, and this was one of the contributors to the stock market bust, along with the housing bust. They have issued a lot of debt and used it for equity buybacks. This is dangerous in many ways. It makes stocks more unstable, more heavily leveraged, and well, over the short run, it may cause the stock market to go up. Over the long run, it can lead to more stock market crashes. Historically, some companies have engaged in stock splits or reverse stock splits to alter their stock price. Generally, this has been when the stock price has gone up drastically for a stock split. A stock split does not in any way affect the actual value of the company, so the value of the company is going to be the number of shares times the price of a share after the split, which should be the same overall value as the number of shares times the price of the share before the split. So the price of a share of stock after the split should be the number of shares before the split divided by the number of shares after the split times the stock price before the split. Why do companies engage in this sort of activity? Well, they were largely caused by regulation in the brokerage industry. Before the 1970s, it could cost several $100s just to trade a block of 100 or 500 shares of stock. The first stock I bought was IBM, and I paid over $90 just for the stock trade. Today, that might be $5 through E-Trade. At that point in time, something called an odd lot share, which would be trading a number of shares not divisible by 100, like 32 shares, they would charge even more. So it could be, quite a few $100s just to trade a few shares of stock. So in 1970, if you were a relatively rich individual and you wanted to invest $100,000 in the stock market, this was before mutual funds were very big, you might want to invest in 10 different stocks. You would need $10,000 per stock. If they had to buy at least 100 shares, that means the maximum stock price you could pay would be $100. So companies would attempt to keep their stock price below $100. If it got above $100, they would split the stock and lower it down so it would stay between $20, $80, something in that range, was considered optimal by many companies. There is another video on stock splits that further demonstrates how these calculations take place. In 1975, the Securities and Exchange Commission deregulated the brokerage industry, and this allowed the creation of so-called discount brokers. They allowed the brokers to actually set the fees rather than the government. This created competition, and stock fees dropped quickly. And of course, now with online brokerages, you can trade pretty much anything for under $10 through E-Trade, Ameritrade, one of the other online brokerage. Now, not every company engaged in stock splits. For example, Warren Buffett preferred just to have wealthy people that knew what they were doing investing in at least his Berkshire Hathaway A shares. Those now trade for around $300. Similarly, Amazon is never engaged in much in the way of stock splits. Of course, that is post the E-Trade and cheap trading environment. Amazon shares now trade for around $1,750 per share. Thank you for watching this video on dividends and share repurchase agreements.